Good day, everyone. How are you doing? Welcome to today's class. In today's class, we'll be taking the topic, computations of companies' income tax. And hopefully today, we should be done with this topic. After which, we are also going to look at the application of information technologies in taxation. The application of information technology in taxation. Are we together? Okay. So in our last two classes on this topic, we have taken the persons that are chargeable to tax. We look at the pro forma for the preparation of statement of profit or loss or statement of comprehensive income. And then also we looked at the a pro forma for the computation of assessable profits or loss. I took you guys through the difference between an accounting profit and a taxable profit. Also, we have looked at the basis period, basis of assessment, determination of basis period have also been looked at. And then also, we have also discussed the definition of gross turnover, those expenses that are allowable and not allowable, as well as taxable income and non-taxable income, if you can still remember. And then also we discussed the classification. Did we do that? Did we do that? I'm not sure, but we should do that in today's class. Okay. What we also discussed is the exemption of interest on foreign loans, exemption of interest on foreign loans, and also we discussed the rules, okay, on the deductibility of interest on foreign loans. That's EBITDA. Hello, that's what? That's EBITDA. So in today's class, we will be taking the last part of the topic, computation of companies' income tax liabilities. Again, we'll be taking what? We'll be taking computation of companies' income tax liabilities. So yeah, we are looking at the normal basis for computing companies' income tax payable, which is what we discussed briefly in last class, towards the end of the class. And then also we'll be looking at other bases. What are the other bases? So we have the minimum tax basis, minimum tax basis. We have the turnover basis. We have the turnover basis, and also we have the dividend basis. So these are the other bases of computing companies' income tax payable. So by the end of this class, you should understand the basis of computing companies' income tax in line with the requirement of the Finance Act, not just 2019, but 2020 and 2021. And also the basis of computing companies' income tax and other bases of computing companies' income tax and then compute the company's income tax. Are we together? If you can still remember, before now, the Nigerian tax rate has always been a flat rate of 30%. Has always been what? Has always been a flat rate of 30%. Not until 2020, when the Finance Act of 2019 was signed into law. I think it was signed on January 13th of 2020 and has an effective date of 1st February 2020. It became effective on 1st February 2020. So The Finance Act of 2019 now classify companies into three. The Finance Act of 2019 classify companies into three. And what are the three categories? We have the small company, we have the small companies, we have the medium size company, and we have the large companies according to the classification of the Finance Act of 2019. So again, to remind us, CETA provides that companies' income tax shall be levied and payable for each year of assessment at the rate of 30 kobo for every naira in respect of the company's total profit. So if you do 30 kobo of 100%. So for every 100 naira, or for every 1 naira rather, 30 kobo of 1 naira, that's equivalent of 30%. That's an equivalent of 30%. I hope this is clear. Okay, so again, this is a pro forma, okay, that is for a normal basis of computing companies' income tax. This is a format of how to arrive at the company's income tax. I think I shared a working exercise with you guys, a work example on company's income tax. Did I? Can someone confirm if I do send it? If I did send it? Okay, so the first thing is to bring the profit before tax, the profit as per accounts. So the profit as per accounts is not the profit after tax, because you have not, computed the tax. It is the tax that you want to compute. So you can't have a profit after tax. Please take note of that. Okay. So what do you have? You have a profit before tax, which is usually known as the net profit. As the net profit. So in some tests, it is referred to as profit as per account. It is referred to as what? Profit as per account. Are we together? Okay, so thereafter, we make adjustments for disallowable items such as depreciation, capital expenses on shares, rent disallowed, that is probably the rent, the apportionment of rent that is related to private use or domestic use that is not, for the purpose of the business. Then also donations that does not, that do not qualify under the provision of the 5th schedule of CETA. Okay. So which states that we have like 5 conditions there, if you can still remember. 1, it must be made to an approved institution or fund, such as the Red Cross, Guest Guide, and the likes. Then it should not exceed 10%, those conditions, right? Okay, so then we have general provision for bad debt. Yes, it is only specific provision that is allowed for deduction, okay, in arriving at the company's profit. So any general provision for bad debt to be disallowed, then diminution in value of investments. Then you move to non-taxable income. These are income that are not taxable, but hitherto has been added to, or taken as an income, okay, and was considered in arriving at the company's profits for the year. So you have to deduct it, and they include profit on sales of fixed assets, profit on exports, and then we also have interest on agri or export loans. So thereafter, you can also deduct then you deduct allowable expenses omitted. Allowable expenses omitted. allowable expenses omitted. Then also you add back taxable income omitted. You add back taxable income omitted. So to arrive at what? To arrive at the accessible profit. To arrive at what? To arrive at either adjusted profit or accessible profit. Okay. So please ignore this here at this point. Okay, so you don't need to calculate your education tax at this point. But the reason why it is in this format is that most people usually made mistake that education tax should be on this remainder of accessible profit, on the remainder of accessible profit, whereas it should not. So in line with the definition of education tax, so it is based on the accessible profit for the year. Then, and the accessible profit, which is usually known as the adjusted profit, okay, before adjusting or considering balancing charge, loss relief, investment allowance, capital allowance, balancing allowance or balancing allowance and the likes. Okay, so again, accessible profit is to be education tax payable is to be computed on the accessible profit, that is the adjusted profit after adjusting for taxable income omitted, allowable expenses omitted, non-taxable income and disallowable expenses. Then after you bring in your balancing charge, remember how you arrive at a balancing charge. So then you take care of your loss relief, you treated loss relief, so you should understand this by now. Then you also adjust for investment allowance to arrive at the remainder of accessible profit. So in some tests, it is arguable that investment allowance should also form part of the capital allowance. So while your computation of tax rate, in computing the tax written down value of an asset, investment allowance will not be considered. But while considering the deductions before arriving at your total profit or taxable profit or chargeable profit, whichever. Okay, so anyway, anyhow, any approach you follow, you will still arrive at the same answer. Okay, so I haven't done all of this, but it is advisable to bring your investment allowance as part of under this capital allowance heading. Okay, so or you deduct it separately. You deduct it separately. So you adjust for your loss relief, then if you have remainder of accessible profit to bring it here, then you less investment allowance. Okay, then you deduct capital allowance and the likes. I want to believe you've taken capital allowances in this class. Yes, I can still remember. So you have companies income tax payable at 30%, tertiary education tax payable at 2% of accessible profit. Based on the requirements of the Finance Act of 2019, whether you are using 20% or 30%, or you are using 0%, these approach still remain. Okay, these formats still remain. I mean, there's no changes to the way and manner taxable or chargeable profits of companies are being computed for the purpose of companies' income tax payable and education tax payable. The only thing that changed is the rate. Now we are here. What has changed? I mentioned earlier that the Finance Act of 2019 has classified, companies into 3 categories, and these are small company, medium company, and large company. So the small company are those with, turnover of 25 million naira and below. So their income tax rate is 0. And when you have 0 rate, and you have 1 million naira, for instance, as your revenue or as a profit after tax, or your chargeable income, you have 1 million naira. But the fact that your income tax rate is 0%, so What does that mean? It means you are not paying any tax. So you have nil. Am I making any sense? Is that correct? So you have what? You have nil. So that's just it. Okay. So then for the medium-sized company, these are companies with a turnover of between 25 million naira and 100 million naira. That is the turnover between 25 million and 1 to what? To 99,999,999 million. I hope you get that. To 99,999,999 million. Is that clear? Why companies with a turnover of 100 million naira and above, companies with turnover of 100 million naira above are subject to tax at 30%. Why those that have a turnover of between 25 and 100 million, they are subject to tax at 20%. I hope we are on the same page. Do you understand? So this is the normal basis for computing companies' income tax. Then we can move to the other basis. Kende, you are welcome to class.
Thank you, sir.
Okay. So the other bases are the minimum tax basis, turnover basis, and then dividend basis. And I want you to pay attention to details as we move on with the class. Okay, so using the minimum basis in line with section 33 of the Companies Income Tax Act, minimum tax is levied and payable by a company for any year of assessment where in ascertainment of total assessable profit from all sources, a loss occurs, or tax on profits, okay, tax on total profits is less than the minimum tax as determined below. The minimum tax as determined below. Now, the first two circumstances is that where the company has incurred loss, okay? So the total assessable profit from all sources, results into loss. Now, and secondly, is that based on the computation as per the minimum tax basis, the tax payable is higher than that of the normal basis. So the taxpayer will pay the higher of the two. So the old basis of preparing the tax, minimum tax, is as follows, and it's quite straightforward and simple, just for you to know what to do and how to apply it. Okay, though it is not as simple as the new basis, and which is what you guys should be doing in your exam. But these I put in my slide just for reference purpose, and we never can tell if the examiner chooses to test your understanding on the extant tax law. So wherever turnover is below or 500,000 naira, is 500,000 naira or below, then the minimum tax payable shall be the highest of 0.5% of gross profit. So if our gross profit is 1 million naira, if you do 0.5% of gross profit, what do you have? You have what? What do you have? You have 500 naira, Abi. Then if our net assets is, let's say, 10 million naira, and you do 0.5% of the 10 million naira, what will you have? What will you have? Oh, sorry, this one should give us 5,000 naira. So if you do this one will give us 50,000 naira. Please punch your calculator to confirm this figure. Kehinde, are you there? Ogenechuko, you're welcome to class. Can you guys please punch your calculator to confirm these figures for me? So if our gross profit is 1 million naira, what will be the 0.5%? And if our net asset is 10 million naira, what will be the 0.5%? So if my paid up share capital is 1 million naira, my paid up share capital is 1 million naira. What do I have? I have 25. I have 25. Then if my turnover is 500,000 naira, if my turnover is 500,000 naira, what do I have? Is 0.25% of 500,000 naira. What do I have? Hello? Yeah, punch your calculator now. Are you guys? Hello, can you hear me? Hello, can you hear me? So that's 1,250. 1,250. So which one is higher? So it's like 0.5% of our net assets is higher. That's 50,000 naira. So you do 50,000 naira plus where the turnover is above 500,000 naira. So the minimum tax payable shall be the sum of what? The highest factor in I above. And which of these is the highest? The net assets. Okay. So if you do 0.5%, 0.5% of 10 million naira. So we have 50,000, which is the highest. So then plus 0.125% of turnover in excess of 500,000 naira. So if our total turnover is, say, maybe 15 million naira, is 15 million naira. So what we just do now is to do what? 0.125% multiply by what? Multiply by 500. Sorry, we've taken out 500,000 before, so it will be 15 million naira minus what? Minus 500,000 naira. 15 million naira minus 500,000 naira. So we have 14 million. We have 14,500,000 naira. Abi? We have 14,500,000 naira. So that gives us what? That gives us 18,125. So you just add 18,125 plus 50,000 naira. What do you have? You have 68. You have 68,125. You have 68,125. Are we together? Okay. So, hello, can you guys hear me? If you can hear me, please unmute your mic and speak.
Yes, I can hear.
Okay. So that's that. I hope you understand. So minimum tax is not applicable to a company where it's carrying on agricultural trade or business, and where at least 25% of its equity is imported. So when a company's equity contains of at least 25% imported equity, maybe foreign direct investments, then it is exempted from minimum tax. Then the company has not been in operations for more than 4 years. So if the company is still operating within its first 4 years, within its first 4 calendar years of its commencement of business, then the company shall be exempted from this basis. Please take note. Okay, please take note. So based on my illustration here, I want you guys to practice this work example. Okay, based on what I just did. So I want you to practice this work example to test your understanding, to test your understanding. So what you just need to do is to compute what? You compute your company's income tax. Okay, so compute your company income tax based on the information we have here. Then you also compute based on the new basis. Then still on the minimum tax, in line with the Finance Act of 2019. So in computing our minimum tax now, what we just have to do is to apply 0.5% of our gross turnover straight. So if we are using the Finance Act of 2019 now, okay, so to compute our minimum tax is very simple. So let's look at this question. Revenue is 23 million naira. Then do we have other income? Okay, so we were told that revenue was overstated, so it means we have to adjust for it. So out of this 23 million naira, we have to take out 650,000 naira, isn't it? We have to take out 650,000 naira. So let's look for another information that may assist us in our computation. So there's no information about other income. So based on the Finance Act of 2019, which says that minimum tax is computed at a fixed rate of 0.5% of gross turnover. And our gross turnover for this purpose is what is all is income from all sources, is what is income from all sources, less non-taxable income from which no further tax is payable, franked investment income, tax exempt income, okay, then what? Capital allowances, and the likes. So now these are our gross turnover. So 23 million naira minus 650. What do we have? Oh yeah, you guys, are you not with your calculator? Hello, I'm not with my calculator. Raise up your hand. I am not with my calculator. Raise up your hand. So if you deduct, oh Kende, next time you are coming to this class, please come with your calculator. It is important. Okay, so you can use your computer now. Are you using your laptop or you are using your phone? Kende, are you using your laptop or you are using your phone? Hello, I hope you can speak from where you are. Okay, you are using your phone. You can use your phone calculator now. Yeah, use your phone calculator so that we can be on the same page. So if you deduct 650,000 from 23 million, you should have 22,350 million. So what you just need to do is to multiply this by 0.05%. Is to multiply it by 0.5% rather. 0.5%. Multiply it by 0.5%. So what do you have? 22,350 multiplied by 0.5%. Figure me. What do I have? Multiply by 0.5%. So I have 107.50. I have 111,750. I have 111,750 as what? As my minimum tax, using the minimum tax basis. Are we together? So in computing minimum tax, frank investment income is first deducted from the gross turnover. And where frank investment income had been included in gross turnover, and the amount derived is multiplied by what? Is multiplied by 0.5%. So frank investment income is divided under section 80 subsection 3 of the Act as what? As dividend received by one company from another company after deduction of withholding tax as specified in that section. Again, section 80 or subsection 3 of the Companies Income Act defines dividend as frank investment income as dividend received by one company from another company after which deduction of withholding tax as specified in that section has been deducted, after withholding tax has been deducted. Are you guys following? Hello, are you following? Okay, so still on the amendment to SITA, any dividend that has not suffered withholding tax is not frank investment income. Please take note. Okay, any dividend that has not suffered withholding tax at source is not or shall not be considered as a frank investment income, and shall not be deducted from gross turnover for the purposes of minimum tax. So it will be what it will be taken or considered as part of the gross turnover. So it means that for dividend to qualify for deduction from the gross turnover, it must have suffered withholding tax at source. So provision of evidence of withholding tax suffered is a condition to be met before treating dividend income as frank investment income. So if you see a frank investment income, okay, so while reviewing the file of the taxpayer, what do you have to do? You have to confirm, sir, ma, can you please provide me with the evidence of the withholding tax remitted, evidence of the withholding tax remitted on this dividend before it can be considered as a frank investment income. So if the client or the taxpayer is saying blah blah blah, and that time with the dots, it's like we paid, but so if there's no concrete evidence, so there's no document to show that the withholding tax has been remitted, then it should not be considered as a frank investment income. So again, frank investment income is only deductible where it has been included in the gross turnover and there is an evidence of withholding tax suffered. Again, gross turnover is the gross inflow of economic benefits. It could be in form of cash, revenues, receivables, or other assets arising from the operating activities of a company, such as sale of goods, supply of services, lending of money, letting of assets, granting of rights, investment activities, etc. Again, gross turnover for the purposes of minimum tax includes all operating incomes or revenues anywhere embedded. So let's take this illustration. I hope you are with your writing materials. Hello. Hello, somebody. Are you there? The
Yes,
following
sir.
information was extracted from the statement of profit or loss of ABC Limited. All information here assumed to be correct. Turnover, profit, blah, blah, blah. So we have notes to the accounts which further disclose the following: revenue from discontinued operations, less expenses on discontinued operations, blah, 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 blah. Sorry, I need to read fast. You have to compute the minimum tax of the company. You have to compute the minimum tax of the company. So what is in computing the minimum tax? So what is the first thing we are looking at? Oh yes, Soro. What's the first thing we are looking at? In computing the minimum tax, so what's the first thing we are looking at here? Based on the provision of the Finance Act of 2019, what is the first thing we are looking at? Hello?
I think it's to check the turnover if it's less than 25 M or more.
So we have to check the turnover if it is what? If it is less than 25 million naira or more than. Because if it is not up to 25 million naira, then we should not waste our time because the company is exempted from what? Is exempted from paying tax. No be so. The company is exempted from paying tax. So in the case of this company now, we are told that the turnover, because that's what we are asked to do, Abby. We are asked to compute the minimum tax of the company. So our turnover here is what? Is 20 million naira. Then we have profit from discontinued operations, profits from other non-core activities. So don't forget that our turnover is based on what? Gross turnover. We have turnover from main business, so that's 20. Then we have rent received, so you add it to this, Abi, plus. Then we have dividend received. So do we have any information that the dividend is a frank investment income? So the examiner is not specific. Okay, the examiner is silent. So we treat it as frank investment income. Then do we have interest received? Do we have interest received? Yes, interest received from group companies. So interest received will form part of our turnover. So you have to do plus this. So then we have profit, revenue from suspended operations. Revenue from suspended operations. That's how much? That's 1.5. So is it up to 25 million yet? That's 1.5. Then what else? What else? What else? No, sorry, it's not even the profit that we need, because it's minimum tax we want to compete. It is the revenue itself that we need. Do you understand? So it is the revenue itself that we need. So let me add some slide. So what's the name of the company? ABC Limited. So computation of minimum tax. Okay. Computation of minimum tax for what self-assessment are we doing for? We are not giving a specific year, Abi. So for the relevant assessment year. Okay, so we have turnover from main business activity, turnover from main business activities. So that's 20 million naira. Then we have turnover from discontinued operations, that's revenue. Okay. Revenue from discontinued operation, revenue from discontinued operation, that's 6 million naira. And we have rent received. So don't forget that the definition of gross turnover is what? It includes our income from letting of assets, granting of rights, investment activities and the like. So we have rent received, which is 1 million naira. Rent received, 1 million naira. And we have interest. We have interest. We have interest received. We have interest received. Oh, we also have revenue from other non-core operating activities. Interest received. How much is our interest received? 1.8 million naira. And we have revenue from non-core activities. How much? How much is that? 3 million naira. $3 million. So what else? What else? What else? So you see in some tests, okay, in some tests, they do include dividend received, okay, but they will treat it as what? They will treat it as in and out. So meaning it will form part of the total gross turnover, and they also deduct it as frank investment income. So for instance, they will say dividend received. Dividend was dividend received. We have 2 million naira. Dividend received from XYZ, we have 2 million naira. So yeah, who is doing the summation? Hello, who is adding this up for us? Mary, Kinde, are you doing that? Yeah, who is doing the summation? 20 plus 6, 26 plus 1, 27 plus 1, 28 plus 3, 31 plus 2, 33. Is that what we have? 33,800. Is that what you have? So this is what? This is the total.
No, sir. I'm having
Eh?
29,400. This one is 300, right? 303. Okay, 3 million.
It's 3
300.
million.
Okay.
No, it's 3 million.
Okay.
Yeah.
Okay.
So we have total revenue. Total revenue. Okay. So we have total revenue less frank investment income. And what's our frank investment income here? Dividend. Have we? Dividend received. So which is 2 million naira. So if we deduct that, what do we have? So we have 31,800. We have 31,800. So 31,800 is our what? 31,800 is our gross. 31,800 is our gross turnover. Is our gross turnover for the purpose gross turnover for the purpose of minimum income tax. For the purpose of minimum income tax. So we have 31,800. So our minimum tax will now be what? Minimum tax at what? As 0.5%. Minimum tax at 0.5% multiplied by 31,800. So what do we have? 0.5% multiplied by 31,800. What do we have? 0.5% multiplied by 31,800. What do we have?
159,000.
More than what?
159,000.
159,000. Okay. So this is how you compute your minimum tax. Is it understood? Any question before we move? Any question before we go? No question? Okay. So the minimum tax rule is applicable to all companies except those specifically exempt by the Act, namely those companies with a gross turnover of 25 million naira and below, and companies carry on agricultural trade or business as defined in section 11, subsection 4 of SITA, and any company in its first 4 calendar years of business. So these are the categories of companies that are exempted, from this basis. And then also the Finance Act of 2020 and then that of 2021 gives an incentive to taxpayer, and the incentive is that because of the COVID-19 that happened in 2020 and the EndSARS issue, the companies are granted a reduction. So instead of 0.5%, they were giving what they are giving is 0.25%. So that is, this 0.5% was reduced by 50%. Was reduced by what? Was reduced, sorry, by 50%. But this reduction is just for 2 years of assessment, beginning, okay, 2 years of assessment between 1st of January 2021, between 1st of January 2020 rather, between 1st of January 2020 up to 31st December 2022. 31st December 2022. So you have just 2 years of assessment. You know, this is 3 years of assessment, 2020, 2021, 2022. But taxpayers can only enjoy for 2 years. So if they have enjoyed in 2020 year of assessment and 2021 year of assessment, then the relief is no longer available for you. Okay, so you cannot use it in the 2022 year of assessment. Do you understand? But most taxpayers, enjoy this reduction in 2021 and 2022 assessments years. So Section 105 of the Companies Income Tax Act haven't been amended by Finance Act of 2020. Again, the gross turnover means the gross inflow of economic benefit during the period arising in the course of the operating activities of an entity, when those inflows result in increases in equity other than increasing relating to contributions from equity participants, including sales of goods, supply of services, receipt of interest, rent, royalties, or dividends. So the FIRS in this case is giving the discretionary power by virtue of provision of Section 30 of CETA to assess and charge the company to tax on a fair and reasonable percentage of the turnover of the trade or business, and the FIRS is entitled to exercise this power in any of the following circumstances where it appears. I hope you are aware that we have moved to the gross turnover basis. Okay, we have moved to the the turnover basis. Okay, so we have moved to what? We have moved to the turnover basis, or you take it as gross turnover. So in line with what? In line with Section 30. Section what? Section 30 of CETA. Section 30 of CETA. So in line with this section, the FIRS has the discretion to assess and charge the company to tax on a fair and reasonable basis based on the turnover of the trade or business. So the FIRS is entitled to this power in any of the following circumstances. One, where during a particular year of assessment, the company has no accessible profit. The company has what? The company has no accessible profit. And secondly, accessible profits which in the opinion of the FIRS are less than might be expected to arise from that trade or business. Accessible profits which in the opinion of the FIRS are less than might be expected to arise from that trade or business. And thirdly, the true amount of the accessible profits cannot be readily ascertained. The true amount of the accessible profits cannot be readily ascertained. Are we together? So Section 31, subsection 2 of CETA having been amended by Finance Act of 2021, any company that transmits, emits, or receives signals, sounds, messages, images, or data of any kind by cable, radio, electromagnetic systems, or any other electronic or wireless apparatus to Nigeria in respect of any commerce, trade, or activity, including electronic commerce, application store, high-frequency trading, electronic data storage, online adverts, participative network platform, or online payments, to the extent that the company has significant economic presence in Nigeria. I want to believe you still all remember the idea behind the significant economic presence. The significant economic presence. I think we have done it in this class, right? Hello? Have we done significant economic presence? Hello? Hello? Have you heard of this term before, significant economic presence?
No, no, sir.
Oh, are you saying no? We treated this under the taxation of trust, settlement, and the estate. Oh, you've forgotten. Eh? You can't remember again. And I think we also treated it under, we treat something like this while taking you on stamp duty. Can you remember? When a duty will be assessed electronically. You have forgotten. Please, so you need to go back and revise your note. This is very, very, very important. So, section 31, paragraph 2 of CITA, having been amended, provides that any company that transmits, emits, or receives signals, sounds, messages, images, or data of any kind by cable, electronic data storage, online adverts, participative network, platform, or online payments, to the extent that the company has significant economic presence in Nigeria, assess and charge that company for the year of assessment on such fair and reasonable percentage of that part of turnover attributable to that presence. So this has to do with a company that is not a Nigerian company, okay, foreign company, and not having a fixed base in Nigeria, okay. So the basis of assessing a company to tax may also be on a turnover basis, okay, because the company is not resident in Nigeria. So the FRS may choose to assess such taxpayer based on this turnover approach. And in doing so, they get a fair and reasonable percentage. So what is fair and reasonable is what we need some explanation on, because the tax authority has the discretion, but in practice, it has always been at 20%. So for instance, if the company's tax rate is, say, 30%, so a fair and reasonable basis of 20% on the turnover, which is 20% multiplied by these 100 million naira, what do we have? 20% multiplied by 100 million naira, what do we have? We have 20 million naira now. Abi? Oh yes, sorry, now please talk. Oh. We have 20 million naira. So they multiply by the tax rate, 20 million naira multiplied by the applicable tax rate. Let's say, because a company that has a revenue of 100 million naira is assessed on 30% now. This is a large company, isn't it? According to the Finance Act of 2019. So 30% of 20 million, how much is that? That will give us 6 million naira now. Am I correct? That will give us 6 million naira. And you now see that assessing based on the turnover, gives more, or higher tax liability than assessing based on the normal basis, isn't it? So, and what does the law say? The law says that the tax authority has the discretion, okay? So they have the discretion of taking the assessable profits, because in their opinion, these 20 million naira represent the assessable profits. Okay, it represents the assessable profit. So there's no need for adjusting for any kind of adjustment. Okay, so the only thing we adjust for here now is the loss relief brought forward and the balancing charge, the loss relief and the balancing charge. So let's do it and see what we will have. Okay. So who is reading the question for us? Oh, yeah, who is reading the question? Hello. No volunteer. Okay. Oh. An extract from the company's financial statement revealed the following additional information: gross profit, net assets, share capital, shareholders fund. A desk examination by the Inland Revenue officials revealed the following: revenue was understated, expenses were overstated by 1.5 million naira. Please take note, revenue was understated. So if revenue is understated, what do we do? So it means that we add to the revenue, isn't it? We add to the revenue. So the revenue already is 100 million naira. Okay, so the revenue already is 100 million naira. So we add 5 million naira to it, that's 105. Then expenses were overstated by 1.5 million naira. So the expenses that was overstated was, do we have to bring back the expenses that was overstated? No, because our concern is on the revenue and not the expenses, and we are not computing any adjusted profits. So the tax official observed that the accounts submitted by the company were not reliable, and that based on the industry average, the gross profits percentage of about 10% reviewed by the company's accounts was not reasonable. Accordingly, the revenue decided to revise the company's income tax computation by applying a fair and reasonable percentage of 25%. By applying a fair and reasonable percentage of what? Percentage of 25% on the revenue. So the revenue here is referred to as the Federal Inland Revenue Service. The Federal Inland Revenue Service, and it's not the same as this revenue. You can see that the R started from what? Capital letter R. So it's not the same as this revenue as in sales. So you are required to recompute the company's income tax liability for the 2014 assessment year. So have it in mind that the tax liability has been computed already based on the normal basis. Okay, as per the normal basis, it has been computed to be 795,000, but we have to recompute it based on what our turnover approach. Are we together? So our suggested solution, what's the name of the company again? We have Ojokoro Nigeria Limited. Ojokoro Nigeria Limited. Abi, recomputation of what? Of companies' income tax liabilities. Recomputation of companies' income tax liability. So we have this. So don't forget that we are computing based on what? Based on turnover. So another thing we should have added here is, what type of assessment are we doing for? So this 2014 assessment here, have you? So we are doing for 2014 assessment here. The computation of companies' income tax liability for 2014 assessment year. For 2014 assessment year. For 2014 assessment year. So we have this and this. Okay. So revenue So our revenue is how much?
105 million.
So the turnover is 100 million naira, Abi. But in the additional information, we were told that revenue is understated but it's 5 million naira. So we have to bring it back, Abi. So that's 100 million, Abi. 100 million plus 5 million naira. What do we have? We have 105 million naira. We have 105 million naira. So then based on the turnover basis, so fair and reasonable percentage, fair and reasonable percentage, which is at 25%, or is it not 25%? It's 25% now. So we have, multiply this by 25%. What do we have? 25% of 105. What do we have? We have 26, 350. Am I correct?
Yes, sir.
So let's, do you have any loss relief? So unrelieved losses brought forward 1.2 million. Yes. Unrelieved loss brought forward 1.2 million naira. Then if you deduct this from this, what do we have?
25,050.
What do we have?
25,050.
25,000, 25 million.
Sorry, million, sir.
Is it 25,000, 25 million?
Million.
We have 25 million naira now. Then we have balancing charge. Do you have balancing charge in the question? So we have balancing charge of 500,000 in the question. Balancing charge, 500,000 naira. So if we add this to this, what do we have? We have 550. Abi? Hello, you guys are not talking.
Yes, sir.
Then you deduct capital allowance. You deduct capital allowance. You deduct capital allowance. So how much is our capital allowance? Our capital allowance is 2.5 million. Deduct capital allowance, 2,500,000. Then we have this. So we have 50 again. And we have 23,050. So our total profit, is 23,050,000 naira. 23,050,000 naira. So our company's income tax at 30%. Why are we using 30%? Hello? Why are we using 30%?
Because the turnover is more than 25.
Eh?
The turnover is more than 100.
Okay, the turnover is more than 100 million. So company's income tax are 30% of total profit, 30% of total profit or chargeable profits. What do we have? 30% of 23,050. What do we have? Oh yeah, what do we have now?
915,000.
We have 6, 9,
15.
1, 5, 6, 9, 1, 5. million. So yeah, so what was the effective tax rate? Effective tax rate. So what's our effective tax rate now? Effective tax rate is what? Is 6,915,000 divided by 23,050,000 multiplied by 100%. So what do we have? What's our effective tax rate?
30%. 30%.
12%.
30%.
4%.
30. 3 and 0. 30%. 30.
Our effective tax rate is 30%. No, sorry. Do 6.9 over revenue rather. On the total revenue. The total revenue is 105 now. On the total revenue, 105. Yeah, what's the effective tax rate? What's the effective tax rate? 6,915 divided by 105 million.
6.59.
Eh?
6.95.
6.95, Abby? Eh?
6.59.
6.59.
Yes, sir.
Okay, 6.59%. So to test this, the examiner said we should use 25%, Abby. And because the company's revenue is 100 million naira and above, so the applicable tax rate is 30%, Abby. So now, alternatively, our effective tax rate is what? Is 25%, which is the fair and reasonable percentage multiplied by the applicable tax rate. So we should have the same thing. If you do not have the same thing, then something is wrong somewhere. So what do we have? 25% multiplied by 30%. What do you have? Hello? 25% multiplied by 30%. What do you have?
0.075.
Eh? What do you have?
0.075.
0 point
0.075.
0.071. Abby?
75.
0.075. 0.075.
Yes, sir.
Abby?
Yes, sir.
Is that what you have?
Yes, sir.
So now, why didn't we get 6.59%? Now remember that we have made adjustment. Abby, we have made some other adjustments. So if you do unrelieved loss brought forward as a percentage of revenue, then you do capital allowance as a percentage of revenue and balancing charge as a percentage of this revenue. What do you have? Oh yeah, what do we have? So if you do minus 1.2 divided by 105 million, so we have 0. We have minus 0.011. Abby, we have minus 0.011. Then we have balancing charge to now 500,000. So if you do 500,000, of
0.0047.
Eh? What do you have? That's 0.0005. Let's try approximate it. Abi 0.005. Then lastly, so this one will be plus. So we added it, Abi. So it's not in bracket. So it's plus here. Then lastly, we have the capital allowance. So our capital allowance is 2.5 million. So 2.5 million of 2.5 million divided by 105 million. So we have what? We have 0.0224, Abi. Oh yeah, punch your calculator now. Say 0.075 minus 0.011 minus 0.011 plus 0.005 minus 0.024. Something is wrong somewhere. Anyway, so the bone of contention here is that something is wrong somewhere. But the objective here is that if you apply the 30% on the fair and reasonable percentage, now holding all other factors constant, that is, there's no unrelieved loss brought forward, there's no balancing charge, there's no capital allowance. Okay, so the effective rate should also give us what? Should give us the same rate that we have here. Should give us the same rate that we have here. So that's it. So let's move on to avoid time waste. So let's move on to avoid time waste. Sorry. So you can try that on your own later. So it's a simple mathematics. So then we move to the dividend basis in line with the section 19 of CETA. In line with the section 19 of CETA. So where a dividend is paid out of profit, on which no tax is payable, due to one, there's no accessible profit, or the accessible profit is lesser than the dividend paid or proposed. The accessible profit is less than the dividend paid or proposed. So the company paying the dividend shall be charged to income tax, at the rate of 30% of the dividend paid or proposed, as if it were its total profit for the assessment year, to which the accounts from which the dividend was declared relate. So assume that during the year ended at 1st December 2012, ABC Limited paid a dividend of 35 million naira, while its total profit for 2013 assessment year, based on the account of to 31st December 2012, was 20 million naira. So, it is a common sense. You are paying dividend of 35 million naira when your profit for the year is 20 million naira. So where do you get the 15 million naira from? The remaining 15 million naira. I hope you guys are following. So is something an ordinary person will ask. Now you say you say 5 million as dividend. So where is the 15 million naira coming from? So it's a simple analogy. So what do you do in that case? So invoking the provision of section 19 of CETA, the Federal Inland Revenue Service would revise the company's tax liability for 2013 assessment year by substituting 35 million naira for the company's total profits of 20 million naira. So it's a simple arithmetic. So instead of arguing with the company, no. So what you just have to do is to substitute, 20 million naira for 35 million naira. Assuming that the company's accessible profit for the year is what? The company's total profit for the year is what? Is 35 million naira and not 20 million naira. I hope you understand. So the implication is that the company pays more tax as the amount due would be revised from 6 million naira, that is applying 30% on the 20 million naira, to 10.5 million naira. Can you see the difference? Okay, so it means that if had the tax authority not applied the dividend basis, the company would have paid 6 million naira, and it seems that the government will be losing 4.5 million naira. Government will be losing 4.5 million naira. I hope you understand. So, but using the dividend basis, the government could collect more money from the taxpayer, and that's about 4.5 million naira. Are we together? So, and that's why is either where there's no accessible profit, or that the accessible profit for the year is lesser than the dividend paid or proposed, as in this case. You can see the total profit is 20 million naira. Why the dividend paid is 35 million naira. Are we together? So we have an illustration here. Okija Nigeria Limited engages in the marketing and sale of spare parts. Its financial statement for the year ended 30th September 2013 revealed the following. All figures there are assumed to be correct. So taxation accounts, we have all of these. So do we have dividend paid? Yes. So what's the dividend paid? The company paid dividend of 60 million naira. The company paid what? The company paid dividend of 60 million naira. And what was the profit for the year? The profit for the year is what? Is 69 million naira. So here now we have to compute the accessible profit. So having a profit or accounting profit of 69 million naira does not mean that the company has a total profit or taxable income of 69 million naira until you made necessary adjustments in line with the tax provision. So the retained profit is 9 million naira, and then you have to compute the company's income tax payable for 2014 assessment year. You have to compute the company's income tax payable for 2014 assessment year. Okay, so to achieve that, you need to first compute your accessible profit. You need to first compute your accessible profit. So once you have done that, then you apply the provision of Section 19 of CETA, which is the dividend basis. And whichever is higher is what you recommend for the tax authority, is what you recommend that the tax authority should assess the taxpayer. Are we together? Okay. So you have a question?
No, I'm just following.
Ma?
Unless no, I don't. You asked if we're following, and I said yes.
Okay. Thank you. So the subsection, I said section 19 is on turnover, but in line with the provision of the Finance Act of 2019. So this amendment to the CETA, now excludes the following classes of dividend from the application of section 19 subsection 1. So what subsection 2 is saying is that before we don't have this subsection 2. So it is a new insertion of the new insertion to the existing tax law. So 1, dividend paid out of retained earnings of the company, provided that the dividends are paid out of profit that have been subjected to tax under Companies Income Tax Act, Petroleum Profit Tax Act, or Capital Gains Tax Act. So now in this question now, what do we see? So you notice that the company had paid tax already. No be so. So ordinarily or originally, the profit for the year is 115, Abi. But tax has been computed and paid, Abi. So we have income tax expense of 46 million naira. We have income tax expense of 46 million naira. So going by the provision of these new acts, so it means that this company now, okay, So having known fully that the dividend that was paid out of the remainder of the profit after tax. Okay. So, but that still did not stop you from doing your own assessments. Then we have dividend paid out of all tax exempt incomes pursuant to the Capital Gains Tax Act, Petroleum Profit Tax Act, and Industrial Development Act, or any other legislation, and all frank investment income under CETA, as well as distributions made by a real estate investment company with shareholders from rental or dividend income received on behalf of those shareholders. Okay, so this is in line with the provision of the Finance Act of 2019 and 2020. So in determining, so we have the following illustration. In determining whether a dividend has been paid out of retained earnings for the purposes of Section 19, subsection 1, profit of the current year disclosed in the financial statement shall be considered first. Okay, do you get that? Profit of the current year disclosed in the financial statement shall be considered first. So was in this case the profit disclosed is 69 million naira. Abi? So then, where the profit reported for an accounting period are sufficient to cover the dividend declared for that year, such dividend will not be treated as having been paid from retained earnings. Okay, such dividend will not be treated as what? Will not be treated as having been paid out of retained earnings. So it means that the exemption will not be what? Will not be granted. The exemption will not be granted. So now we have an extract. The accounting loss for the year is 800,000 naira. So retained earnings brought forward is 1 million naira. Retained earnings brought forward is what? Retained earnings brought forward is 1 million naira. And dividend declared is what? Is 600,000 naira. So it is obvious that this dividend was not paid out of the profit for the year, because in the year the company made a loss. So it is obvious that it was paid out of retained earnings. And what does the law say when dividend was paid out of the retained earnings? So dividend paid out of retained earnings of a company, provided that the dividend are paid out of profits that have been subjected to tax under company's income tax. So this dividend of 600,000 is obvious that it was paid out of a profit that had already been subject to company's income tax in 2019, because we are now in 20 year of assessment. So it is not the dividend for the year. So such will not be subject to the application of Section 19, subsection 1. So it is exempted. I hope you are following. Is it understood?
Yes, sir. Yes.
So in the second case here, the profit for the year is 5 million naira, and retained earnings brought forward is 10 million naira, and dividend declared for 2019 and paid in 2020 is 7.5 million naira. So in this case, should this dividend declared for 2019 be subject to the provision of Section 19, subsection 1 of CETA?
Yes, sir.
It should be subject to it, Tabi, because the profit for the year is 5 million naira and the retained earnings brought forward is 10 million naira. So one can conclude that 2.5 million naira was paid out of the retained earnings brought forward, while 5 million naira was paid out of the profits for the year. No be so?
Yes, sir.
So therefore, the 5 million naira will be subject to the application of Section 19, subsection 1 of CETA. And if that will be subject to the application of Section 19, subsection 1 of CETA, so it means that you have to do what? You have to compute, you owe the 5 million naira, then you do your recomputation of accessible profit. So the 5 million naira will be taken as what? Will be taken as the accessible profit for the year. Then you apply the applicable tax rate. So the illustration 3, you do it yourself and you submit to me on the class platform. Is that taking? Is that
No,
taking?
sir.
Or
I didn't
you
get
have
the
a
question,
question?
sir. What did you say you should do, sir?
Okay. So the another thing that we had before I go is the exemption of the profit of a small company. So for us to be on the same page, Section 105 of CETA, as amended by the Finance Act of 2019, now exempt all small companies. All small companies, are now exempted from the company's income tax provision payments. So they will still file their normal tax returns, okay? But the thing there now is that they are exempted from paying tax, okay? So now, but there are conditions to this, okay? There are conditions. So without prejudice to this exemption, the small company shall comply with the registration and tax return filing stipulations of this act. Then another thing is that for small companies' profit to be exempted, for those that are in the manufacturing sector, okay, so there are dividends received from small companies in the manufacturing sector in the first 5 years of operations is exempted, okay? So please take note of this. And at the same vein, they are also, since they are exempted from companies income tax, they are also exempted from tertiary education tax, okay? They are also exempted from tertiary education tax. So we should take this under the tertiary education tax again. Are we together? So then for pioneer status, small and medium-sized company engaged in primary agricultural production can be granted pioneer status for an initial period of 4 years and an additional period of 2 years. That is, these are companies that are into agricultural production, and at the same time, they are small companies. So they will be granted pioneer status for an initial period of 4 years and additional period of 2 years. But for every other company, the initial period shall be 3 years and then additional period of 2 years, subject to satisfactory performance. And a reduction in import duty on tractors from 35% to 5%. So to enjoy this tax incentive, these companies are expected to apply to the president through the Minister of Trade and Commerce, through the Minister of Trade and then Commerce. So then for deduction of withholding tax, they are also not expected to pay withholding tax. So they cannot charge withholding tax, neither can they deduct, and then they are not statutorily obliged to remit the withholding tax. But there are circumstances where they might be charged withholding tax, but the provision of the tax law allows for claim of whatever tax they suffered. So, and then for capital allowances too, please note that they are also during the period that they are classified as small companies, they cannot enjoy capital allowance. Okay, so the capital allowances, they will be computing it, but it will not be utilized. So they will be computing it as though they are to take it as a relief, but they will not take it as because they are not paying tax now. So if we are not assessing you to tax, so you cannot be accumulating your unutilized capital allowance up to when you now qualify to start paying tax. Do you understand? So all qualifying capital expenditure shall be treated and computed, and capital allowances shall be computed thereon, but it will not be utilized. So given the fact that the company did not achieve 25 million revenue until when it exceeds the 25 million threshold. So all initial allowances and annual allowances will be deemed utilized in assessments, in all the assessment years until it exceeds the turnover of 25 million naira. I hope you understand this. So then the Finance Act made provision for anti-abuse. So any attempt by a company to split the transactions that were carried out prior to the commencement of the Finance Act amongst 2 or more companies in order to benefit from the exemption of profits of small companies, so that their turnover for particular company will not be up to 25 million naira. Company can do that. So, so because they know that if they are using one company for all their business activities, so it is likely that the gross turnover will exceed 25 million naira, and they don't want it to exceed 25 million naira. So they will structure their business in such a way that they have like 2 or 3 companies, and they have like 3 or 4 companies, and they arrange the business activities for each of these companies such that the revenue will not be up to 25 million naira, thereby exempting them from the payment of companies' income tax. Are we together? So after the commencement of the Finance Act of 2019, any attempt by a taxable person to incorporate new companies or uses 2 or more companies to transact a business, which in the opinion of the FIRS is aimed, at benefiting from the tax exemption of profit of small companies, the value of such contracts shall be aggregated and taxed in the hand of one of the companies. That's just it. So you have company A, B, C, D, and we get to know that these companies are into similar activities or the same activities. So what we do is just to consolidate all the revenue together and compute tax liability as though it is one of the company that has all the revenue. Are we together? So, and then lastly, in line with section 42, okay, section 42 of the FIRS Act says that any company that conceals the turnover with a view to obtaining tax benefit available to small companies shall be prosecuted with its directors. Okay, so the director of the company will be prosecuted and relevant principal officers. So any tax liabilities arising from the foregoing shall be recovered with penalties and interest. So do not do Ojoro. Okay, Ojoro is not good. So that's all for this chapter and for this topic. Unfortunately, we don't have much time. We would have, start the other topic too, which is the application of information technology. But hopefully tomorrow, I don't know, we probably have to put it on hold. Then we start the taxation of specialized businesses, because that will also, take like maybe 3, minimum of 3 classes from us. So let's say tomorrow and Friday. On Saturday, there will be election. So I don't know if we have any other time to fix our class on Sunday. If Sunday morning is, if you are fine with Sunday morning between 8 or 9 to 11, so let me know. Between 9 to 11 or 8 to 10, that would be better. 8 to 10 would be better. So let me know if that will be convenient for you, so that we can also have our class on Sunday morning. So hopefully by Sunday, we should be done with the taxation of specialized businesses. Then we have 2 other topics, which will be tertiary education tax and then application of information technology. I think so. Okay, so that's all. So in this class, we have successfully discussed the normal basis of computing company income tax, then other bases such as the minimum tax basis, turnover basis, dividend basis, and the exemptions, of small companies to tax, then exemptions as regards the tertiary education tax, as well as capital allowances. And we look at other provisions of the Act, such as that of Section 2 of the FIRS Act. So, and that's all. So thank you guys for joining me in class today. I wish you best of luck in your coming exam. So sorry for your short answer questions and multiple choice question. Please refer to page 331. Let me see, page 331 of your study test. No, if I'm correct. Is it page 331? Okay, yes. So refer to page 331 up to 332 of your study test. Okay, for your short answer questions and multiple choice questions. Please do ensure to practice all of these assignments as you get to prepare for your coming exams. So once again, I wish you best of luck in your coming exams. Do have a successful diet ahead. Goodbye. Okay, we still have capital gains tax. We have like 3 topics to go.